Warren Buffett is arguably the greatest investor of our time. On a net worth of over $103 billion, I think we should probably give some of his investing idea a listening here. So in this video, I'll be listing the top takeaways from the 7 Secrets to Investing Like Warren Buffett by Mary Buffett and Seah. So with that said, ensure that you smash the like button for the YouTube algorithm. Hope you enjoy, and let's dive in. Secret number 1, the power of habit. The concept of habit defines who you are, how you live your life, and the results you get from your effort. But before you invest, there are certain aspects of your life that will need some level of modification. The first of which is finding a job you love. Many people tend to work just for money, as oftentimes they don't like their jobs, and this affects you in one of two ways. You either end up losing your happiness in pursuit of a paycheck, or over time you develop a negative pool of emotions that you then carry back home, which is then taken out on your kids or your family. So instead, do a job you love, even if it pays less than something that would pay more, however you would dislike. Because at the end of the day, happy people produce great results. For example, Warren shared a story about a tailor that was obsessed with his job, and one of his life goals was to meet the Pope. Once he had saved up enough money, he took the trip to Vatican to meet the Pope. And when he came back from his trip, people said, "Tell me about the Pope, tell me about the Pope," because they were very interested. He responded that the Pope was a 44 medium. Clearly, the tailor had a passion for his craft, and that is why Warren Buffett says it's important to take a job you love. Don't take a job because you think you look good on your resume, because that's like saving up sex for old age. The next habit that you will need to work on is watching your spending and avoiding bad debt. Albert Einstein says, insanity is doing the same thing over and over and expecting a different result. The truth is, this is where most persons fall short. They get a pay, they pay bills, they buy something nice for themselves, and when other important expenses arise, they have to go into debt in order to stay afloat. And this is where the rise of the credit card came about. A simple concept of providing immediate additional cash for a person, then pay it back with an interest after. Yes, it is helpful, but at what cost? People fail to understand that credit card companies are not a charity, it's a business. And at the end of the day, a business is in business to make money. So credit card companies will give incentives that you can take out the card and you'll get various benefits like travel points and free stuff. But from a statistical perspective, most persons will never really redeem those benefits because they'll constantly be behind on payment, and before you notice, you'll be paying off interest for the rest of your life. So just ensure you manage your risk in not just borrowing, but in all aspects of your life. And since we're on the basis of life, ensure that you take care of your health, because this will pay a huge dividend down the road, saving you from paying a fortune on medical bills in the future. The power of habit is never a sprint, it's a marathon that incorporates Kaizen, which just simply means to continuously improve. Secret number 2, the power of value investing. What is value investing? Do you know of someone who has a huge collection of stamps, or someone who loves to collect baseball cards? Imagine instead of stamps or cards, what you had was a collection of the most profitable businesses in the world. This is what value investing is about, and Warren Buffett has some of the most profitable businesses such as Coca-Cola, Kraft Foods, and American Express in his investment portfolio. But pause for a moment and imagine every time someone buys a soft drink from Coca-Cola or a snack from Kraft Food, or taking it closer to home, how much time you have crossed the toll in Jamaica. Just a quick fact, 1.9 billion Coca-Colas are sold in a single day. That's 79 million cans of Coke every hour, which is 1.3 million cans per minute, or 21,990 cans per second. 1, 2, 3. That's about 65,000 cans sold just now. And if you own the Coca-Cola company, you would be 65,000 cans of Coca-Cola richer every 3 seconds. Similarly, if you own the Trans, you would make about $8 million per day. And that's the idea of investing, to buy and own profitable businesses. And in the stock market, you own companies by buying their shares. So where the value comes from in value investing? Value just simply means that you are buying good companies at good prices. It's similar to being able to buy a nice sports car at, let's say, $50,000, even though it's actually worth $100,000. Nothing is wrong with it. You were just able to catch it when the price was undervalued. These ideas did not originate from Warren Buffett, but from Benjamin Graham and David Dawes, two financial professors that published a book called Security Analysis, which became the guidebook for successful brokers and investors. Essentially, the concept of the book was by studying and analyzing the market, you could determine a stock's real price. And with said information, investors could buy a stock at an undervalued price. Remember the sports car concept? Yes, case in point. Secret number 3. Generating stock ideas. When looking for stocks to invest in, what exact characteristics do you think a great stock would possess? Leave your comments down below. And if you predict any one of these that Warren Buffett listed in the book, leave a like on this. And if you didn't, double tap the dislike button. So the characteristics that Warren Buffett would like for his company to possess before he starts investing are: it should be a profitable business. It should also have a lot of loyal customers. It should always be ahead of trends, and it should be the market leader, and it should have good growth potential. Now with that said, where would you be able to find these companies? Places like shopping malls, or even in a store or a supermarket. Seeing which brands are dominant on the shelf. So for example, Grace is a food company, and oftentimes if you go to a store and you do not see any Grace products, it's very rare. Oftentimes the product line takes up an entire shelf, and this shows the company's brand strength, and it has a loyal fan base, because stores are not stupid. The product would not be there if it was not selling. And I think food is a universal topic that everyone should know about. But let's say you're not interested in investing in food-based companies. Well, search up companies that create a business model that surrounds your interests or things that you know about. And this would be called your circle of competence. It is a relatively simple concept. It just means that you will take a vested interest in only business models that you understand. So let's say you are a fisherman. That is your profession, and that is what you use to make a living. It would be smarter to invest in companies that do fishing equipment or sell fishing products, seeing that you can relate to the business model, compared to venturing, let's say, the stock or the cryptocurrency market business. But not to say that you should only invest in fishing companies. You can invest in other businesses. But before you do, get information on each of the new companies you want to start investing in. And you can find and keep track of various companies through financial websites, news articles, or even social media, as companies tend to have social media pages. And from there, the world and the sea of knowledge is yours to take. Secret number 4. Economic moat. Before Warren Buffett became a full-time investor, he was in the military, and on one of his first practice missions, he learned an important lesson that he started using in his investing journey. The story was about this practice mission that they were on, where essentially the aim was to defeat the other team. And like the novice he was, along with the rest of the new soldier recruits, they wanted to run in guns blazing, but the captain of the team stopped them and explained that we might win that way, but a lot of men will die in the battle. So let's think strategy. How can we have the highest chance of winning with the lowest chance of anyone getting hurt? Then the ideas started floating. What if we went on the higher ground so that we can see the movement in the bushes, then we can attack from there? Or we can set traps in the field and then attack them while they're injured. And that is how the concept of economic moat came about in business, as it is to find the advantage that companies have over their competitors. And these can be branding strength, which is essential. For example, what is more recognizable, KFC or Curry's Cook Shop? Also, having economy of scale, which is the ability to order large volume of raw material or units, which is then incentivized by getting a cheaper cost per unit. This reduction in prices can be passed on to the consumer, and then they can sell each unit of their particular product at a cheaper price compared to the competitor. There's also legal barriers to entry, which is, as it states, barriers placed by law to prevent invaders. Case in point, the taxi companies in New York, there is a set amount of permits that is issued in order to drive and operate taxis on the road. However, there is only a small set amount issued, so no random person can decide to operate taxis without that permit, and that is bound by law. Another moat is high switching costs. This is basically the level of work or capital that will be needed in order to change producer. Examples: power grids. Either you work with the service provider or you go solar, which has a hefty upfront cost. These modes allow business to stay on top, and most times companies might have one or multiple economic mode that make them the ideal business to invest in as an investor. Secret number 5, language of business. To many, the stock market is like a foreign land where trained investors speak a foreign tongue, and that is why many people lose their way in the stock market, wondering how they'll be able to reach their investing destination. The answer to this problem is that they need to understand the language of business, and these are the balance sheet, income statement, and the cash flow statement, each of which serves various purposes. So what is the balance sheet? A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time, and provides a basis for computing rates of return or evaluating the capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. Now for the income statement. An income statement is one of the 3 important financial statements used for reporting a company's financial performance over a specific accounting period, also known as the profit and loss statement or the statement of revenue and expenses. The income statement primarily focuses on company's revenue and expenses during a particular period. The statement of cash flow or the cash flow statement is a financial statement that summarizes the amount of cash and cash equivalent entering and leaving the company. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement complements the balance sheet and the income statement and is a mandatory part of a company's financial report since 1987. Understand that different business models will have various size and types of financials. For example, a restaurant might have expenses like raw material and work in progress, while a consultant business might not have any of those types of raw material or overhead costs working with. Secret number 6, valuation. The ability to value invest is the core skill of any value investor. And as investors, cash is our ammunition, our bullets, and our missiles. And in order to give out our resources, we must aim at high payoff targets. The way to do this is to understand which stocks give the highest return on investment. The key idea of value investing is to purchase an investment for less than its true value. In this way, you capture the value while buying the stock. Imagine if you could buy $1 with only 50 cents. How much dollar would you buy? The answer is more than likely as much as possible. Let's look at a few of the ways in which investors value stocks. Understand that not all methods are able to be used for all business models. So let's begin. The Graham net. The idea of net is to first calculate how much shareholders would get back the company stopped operating and returned all capital to them. This situation is known as liquidation. So the idea is to purchase stocks below their liquidation value. This can be found by using the balance sheet and taking the total liability from the current asset in order to get the net current asset. The second valuation method is the price to book value. It's relatively simpler and oftentimes most websites already pre-calculate them for you. Nevertheless, we should understand how to calculate them ourselves. The key idea behind price to book value is to buy good businesses below their net asset value, which is known as book value or equity. So when we use the book value method to evaluate a company, our aim is to get in at an entry price that is ideally below the net asset value of the business. The PE ratio or price to earning ratio is another tool that is often used. However, instead of determining if the company gives good value to investors based on its asset values, we look at its earning ability, hence the concept price to earning. The aim is to break even on our investment as soon as possible by not paying too high of a price in relation to its capability to earn. Lastly, dividend yield. The idea is to buy good companies that pay out consistent dividend at a good rate. The way to calculate a good dividend yield, we compare the expected dividend per share to the price we are paying for the share. For example, if we are paying $1 for ABC shares and we expect a payout of 10 cents of dividend per share per year, the dividend yield will be 10 cents divided by $1, which would equal 10%. This can also help to calculate how long it would take you to grow your portfolio if it is dividend based. Secret 7. Portfolio management. Have you ever heard the saying, don't put all your eggs in one basket? This speaks to the importance of diversification of your investments to manage risk so that when that one disaster happens, it will not wipe you out financially. Warren Buffett once said, diversification is protection against ignorance. So here are some rules to follow to help you manage your portfolio properly. Rule 1. Start with a fund allocation. At any point in time, decide how much money will go into your investments and how much cash will be set aside for future opportunities. Rule number 2, never put more than 10% in any stock. So according to this rule, you should have at least a portfolio of 15 to 20 stocks. Rule number 3, stronger stocks, higher weight. As we build a list of stocks that we would like to purchase, it's a good idea to rank them in grades of confidence. So a grade A might be a stock that you are really confident in, and a grade B will be a stock that you have faith in but not as confident as your grade A stocks. Although realistically speaking, we would all like our investment portfolio to have all grade A stocks, but oftentimes the stock might not be undervalued at that point in time. Rule number 4, review your portfolio at least once a year. Just do this at least once a year to just keep check to understand where your portfolio is at and what is doing well and what is doing not so well. And in conclusion, just remember to be patient with your investment. It's not a sprint, it's a marathon. Do your own independent thinking. Do not follow the crowd. Focus on your investment journey and just stay consistent with your investment plan. And that is it for this video, guys. Just remember to smash the like button for the YouTube algorithm. Or that's it. Catch you in the next video. Peace.